Imagine it's November 1998, and you're a successful accountant named Roberto living in Buenos Aires. You're 42 years old, married with 2 children attending private school. Your apartment overlooks the Rio de la Plata, purchased with a mortgage you've been dutifully paying for 12 years. The monthly payments are manageable on your salary. You drive a decent car, a Renault, bought on credit but easily serviceable with your income. Your wife manages a marketing firm. Together, you earn enough to feel secure, not wealthy, but genuinely comfortable. You have a pension fund you've contributed to for 18 years, currently worth approximately 150,000 pesos. Your broker assures you this is substantial, enough to retire comfortably in 15 years. You keep additional savings in the bank in pesos, earning modest interest. The government has pegged the peso to the US dollar, and the central bank has made it explicitly clear that this peg is permanent, backed by law. Officials regularly announce that Argentine currency is as stable as the dollar itself. You've even converted some savings to dollars, holding them in your bank account, which feels like the safest possible choice. You own a small vacation property outside Mendoza, purchased in 1996 when you believed real estate would appreciate indefinitely. You have life insurance, taken out at your employer's recommendation. You've followed every piece of financial advice you've received. You've made every decision you were told was responsible. You believe you've built something that will endure. Your children will attend university. You'll retire at 58. This is the trajectory you've constructed, and it feels solid. Then, subtly at first, almost imperceptibly, something begins to shift. It's not dramatic. There's no moment where you think, this is it. Everything is about to change. Instead, you notice small things. Prices at the supermarket seem higher than they were 3 months ago. Your electricity bill increases. The school tuition goes up more than expected. Your salary increases, but not quite as much as prices seem to be rising. You mention it to colleagues at work. They've noticed it too. Everyone assumes it's temporary, part of normal economic fluctuation. The government hasn't announced any crisis. The peso is still pegged to the dollar. Everything officially is fine, but the purchasing power of your peso is declining, slowly, subtly, almost invisibly. Your savings account still shows the same number of pesos, but each peso buys slightly less. Your pension fund value hasn't changed on paper, but its actual purchasing power is eroding every single month. You don't panic because nothing seems wrong. The system appears stable. The government says it's stable. The banks say it's stable. But something is happening, something so quiet that most people don't recognize it as the beginning of anything. They think it's normal. They think it will pass. They don't understand that they're watching the first stage of a pattern that has repeated with mechanical precision across continents and centuries. This first sign is so subtle that almost nobody recognizes it. But it's the beginning of a pattern that has repeated with mechanical precision in every currency collapse in modern history. And once you understand what this first sign means, you'll see it everywhere. This pattern has repeated in Germany, Argentina, Venezuela, Lebanon, Zimbabwe, and Greece. In every case, the same class of people lost the most. And in every case, the 3 stages happened in the same order. The specific triggers were different. The governments were different. The decades were different. But the mechanism was identical. In Weimar Germany between 1921 and 1923, the trigger was war reparations. The Treaty of Versailles required Germany to pay enormous sums to the Allied powers. The government, unable to raise sufficient tax revenue, began printing currency to meet obligations. The central bank, under political pressure, kept printing. Currency flooded the system. By 1923, the hyperinflation reached terminal velocity. A loaf of bread cost trillions of marks. People who had saved their entire lives discovered their life savings couldn't buy a newspaper. A pension promised in 1914 was paid out in 1923 in currency that was worthless. The middle class was systematically destroyed while the wealthy, who had moved assets to Switzerland and Sweden, escaped relatively intact. In Argentina in 2001, the trigger was different. The government had promised the peso would always equal the dollar. It had taken on enormous debt based on that promise. When economic conditions changed and the promise became unsustainable, the government faced a choice: default or devalue. It chose to devalue. Over 36 months, the peso lost 70% of its value against the dollar. Savings denominated in pesos became nearly worthless. Pensions were cut. Bank accounts were frozen. The middle-class Argentine, who had followed every rule and saved diligently, discovered their wealth had been systematically transferred to the government. In Venezuela, starting in 2014, the trigger was oil price collapse. Venezuela's entire economy depended on oil revenue. When prices fell, the government faced insolvency. Instead of adjusting spending, it printed currency. The currency devalued rapidly. By 2016, inflation exceeded 800% annually. Middle-class Venezuelans who had held savings in bolivars watched those savings become worthless. People who had contributed to pension systems discovered the government had seized those funds. In Lebanon, starting in 2019, the trigger was a banking system that had become insolvent through corruption and poor lending decisions. The banks had promised dollar deposits would be safe. When the system failed, the government imposed capital controls, preventing access to deposits. Dollar accounts were forcibly converted to Lebanese pounds at artificial rates. A depositor with $100,000 saw that converted to a value worth perhaps $15,000 in actual purchasing power. In Zimbabwe between 2007 and 2008, the trigger was hyperinflation caused by the government seizing land and printing currency to compensate. Inflation accelerated beyond comprehension. By November 2008, inflation reached 79 billion% per month. Currency became worthless faster than people could spend it. Middle-class Zimbabweans who held savings in local currency lost everything. In Greece after 2010, the trigger was a sovereign debt crisis. The government couldn't service its debt. The European Central Bank imposed austerity conditions. The government, desperate for revenue, imposed emergency property taxes, pension cuts, and capital controls. Middle-class Greeks watched their pensions decline. Their property taxed at government valuations, their bank accounts frozen. The specific currency doesn't matter. The government doesn't matter. The decade doesn't matter. The trigger mechanism differs, but the outcome is the same. What matters is the mechanism. And the mechanism is always the same. A government becomes unable or unwilling to control spending. It prints currency or imposes inflation. As currency loses value, the government becomes desperate. It freezes access to assets. Then it seizes them directly. So what are these three stages? And more importantly, what happens to middle-class wealth at each one? This stage happens in plain sight. Your salary arrives. Prices go up. You think it's normal. But what's actually happening is the most efficient form of wealth transfer ever created. The mechanism begins when a government or central bank starts printing currency. They frame it as economic stimulus, liquidity injection, monetary accommodation. The language sounds technical, responsible, necessary. What it actually means is simple. More money is being created without a corresponding increase in goods or services. When more currency chases the same amount of goods, prices rise. Your purchasing power declines. This happens slowly at first, almost invisibly. You notice that groceries cost slightly more. Your electricity bill increased. School tuition went up. But your salary increased too, so you think you're keeping pace. You're not. The salary increase always lags behind the actual price increase because the government understates inflation in official statistics. Your bank savings earn 1% interest while actual inflation runs at 8%. You're losing money mathematically every single month, but the number in your account looks the same. Your pension fund value hasn't changed on paper, but its actual purchasing power is declining steadily. This is the punishment phase for savers. Meanwhile, those who borrowed money benefit initially. If you took out a mortgage at 5% fixed interest and inflation is actually 8%, you're paying back the loan with currency that's worth less than when you borrowed it. Your debt becomes easier to service. Borrowers gain, savers lose. The middle-class saver, who did everything correctly, who saved diligently, who bought insurance, who contributed to pensions, is systematically punished. The government benefits because it can service its own debt with worthless currency. It can pay employees with currency that buys less. It can meet obligations with money that has lost value. In Zimbabwe, this stage began slowly in 2006. Inflation was noticeable but not catastrophic. People thought it was temporary, part of normal economic cycles. By mid-2007, inflation had accelerated but was still manageable. People who held Zimbabwean dollar savings believed the situation would stabilize. Officials promised it would. The government issued new currency denominations, suggesting confidence in the system. People kept their savings in local currency, waiting for stability. By mid-2008, inflation had reached 79 billion% per month. A loaf of bread cost trillions of dollars. People who had saved their entire lives discovered their life savings were worthless. A middle-class professional with 30 years of savings couldn't buy a week's groceries. Those who had converted to hard goods, land, tools, equipment had something of value. Those who had kept savings in the bank had nothing. In Venezuela, the devaluation began gradually in 2012. The bolivar was valuable. People trusted it. They held savings in bolivars. The first year of devaluation was noticeable but not alarming. Year 2 accelerated the decline, but still, people thought it was temporary. By year 3, the bolivar had lost 90% of its value. Savings that seemed secure in 2012 were nearly worthless by 2015. Those who had converted to dollars early, or who held hard assets, retained their purchasing power. Those who trusted that the situation would stabilize lost everything. In Argentina, between 1998 and 2001, the peso was pegged to the dollar. This peg seemed to guarantee stability. The government had promised it was permanent, backed by law. People trusted this promise. They held savings in pesos. The government, however, was slowly inflating the currency. The peg was becoming unsustainable. When it finally broke in 2001, the peso lost 70% of its value in months. Savers discovered that their trust in government promises had been misplaced. Those who had converted to dollars or hard assets early retained their wealth. Those who waited lost most of it. In Lebanon, starting in 2019, banks offered very high interest rates on deposits. Savers thought these high rates compensated for the slight devaluation of the Lebanese pound against the dollar. Actually, the devaluation was much faster than the interest rates compensated for. Middle-class pensioners who thought their safe bank accounts, earning high interest, would protect them discovered they were losing purchasing power despite nominal returns. The contrast is stark. Savers watching their wealth erode silently while borrowers pay debts with worthless currency. Asset holders watching prices rise while wage workers watch salaries lag behind costs. The middle class gets hit hardest because most of their wealth is in currency-denominated assets, savings, pensions, bonds, insurance products. The wealthy are diversified into hard assets internationally. The poor are already outside the formal system using barter and cash. The middle class is completely exposed. Most people accept this as normal economic cycle. Inflation happens. It's just part of life. But there's a second stage, and this is where the real acceleration begins. Your money is in a bank. It's insured. It's safe. Except it's not. And when institutions fail, savers discover something too late. You don't own your bank deposits. You hold a claim on an insolvent institution. The mechanism in stage 2 begins when currency devaluation accelerates beyond what the government can control. The government becomes desperate for revenue. It has already printed currency to the point where inflation is spiraling. Borrowing more becomes impossible or prohibitively expensive. The government turns to the one resource it can access directly, the deposits held in banks. Banks have become insolvent because they've promised depositors they can withdraw funds, but the banks have lent out most of that money to a government that can't repay it. The math doesn't work. The government has two choices. default on bank deposits, or restructure them. It chooses restructuring. It imposes capital controls, restricting access to money. It activates bail-in frameworks, converting deposits into losses. It doesn't call it seizure. It calls it a regulatory measure, a temporary safeguard, an emergency procedure. Legally, it's all correct. But functionally, your money is frozen. The forms this takes are multiple. Capital controls limit how much you can withdraw. Greece in 2015 limited ATM withdrawals to €60 per day. A person with €100,000 in a bank account could access €60 daily. That's €1,800 monthly, while still owing property taxes, electricity bills, rent, food costs. The math doesn't work. You're trapped. Forced conversion happens when the government decides that dollar deposits will be converted to local currency at a rate the government sets, not the market. In Argentina in 2001, this happened over a single weekend. People went to bed with dollar deposits. They woke up to peso deposits at an exchange rate that had been artificially set by the government. A person with $100,000 on December 1st had approximately $25,000 of purchasing power by February. The government technically honored the deposits. It converted them as promised. But the conversion rate was designed by a government trying to survive, not by market forces. Bank holidays simply close banks. Deposits are frozen indefinitely. In Argentina, banks were closed for weeks while the government decided what to do. People couldn't access their own money. They lined up outside banks, demanding access to funds that were technically theirs but practically inaccessible. Negative interest rates tax savings through rates below inflation. If inflation is 8% and your bank account earns 1%, you're losing 7% annually in purchasing power. The bank is legally paying you interest. You're legally losing money. Deposit haircuts are direct seizures disguised as burden sharing. The government announces that deposits above a certain amount will be reduced by a percentage. 50% haircut means half your deposits are gone. 47% haircut, as happened in Cyprus, means nearly half your savings are confiscated through regulatory action. In Cyprus in 2013, banks had held deposits from across Europe. The euro crisis made those banks insolvent. The government, desperate for revenue and unwilling to default, imposed an emergency levy on deposits. Deposits above €100,000 lost 47%. This happened over a weekend with no warning. People went to bed with savings. They woke up to significant losses. The government framed it as temporary burden sharing. It was permanent confiscation through regulatory procedure. In Greece in 2015, capital controls were imposed overnight. ATM withdrawals were limited to €60 daily. Bank accounts were frozen for weeks. Elderly pensioners couldn't access pensions they'd earned through decades of work. The government called it a temporary measure to stabilize the system. Years later, in modified form, the controls remained in place. In Argentina in 2001, the Carlito froze bank accounts entirely. People couldn't withdraw more than $250 weekly. Dollar deposits were forcibly converted to pesos at an artificial exchange rate. The conversion happened administratively, without consent, legally authorized by emergency decree. In Lebanon starting in 2019, the banking system effectively collapsed. Depositors were told they couldn't access their dollars. Banks forced conversions from dollars to Lebanese pounds at rates the government set. The actual purchasing power loss exceeded 90%. People with supposedly safe dollar accounts discovered their wealth had been systematically seized through administrative procedures. In Venezuela, the government seized private pension systems multiple times. Accounts that workers had contributed to for decades were nationalized. The government promised benefits would be maintained. They never were. Middle-class retirees became impoverished overnight through regulatory seizure of retirement accounts. This stage destroys the middle class because their wealth is concentrated in institutional vehicles, banks, pensions, insurance products. They believe these institutions are safe because they're regulated. They have no alternative access to funds. Unlike the wealthy who maintain foreign accounts and can diversify internationally, The middle class depends entirely on the formal system. Unlike the poor who operate in cash and barter, the middle class is completely dependent on institutional stability. The government calls these measures temporary. Media normalizes the restrictions as sacrifice everyone must share. People wait for resolution that never comes. By the time they understand the situation is permanent, capital controls prevent them from moving money. Stage 2 traps people through administrative procedure. But here's where it gets darker. The freeze isn't the final stage. It's the setup for Stage 3. And Stage 3 is where middle-class wealth doesn't just disappear, it's actively redistributed. When governments become insolvent, they don't negotiate with asset holders. They take, and they use the legal system to do it. The question isn't whether they'll seize assets. The question is which assets they'll seize first. The mechanism in Stage 3 begins when the government faces insolvency despite capital controls and asset freezes. Currency has been devalued. Banks have been drained. Access to deposits has been restricted. But the government still needs money to function. It must pay soldiers, police, bureaucrats, maintain basic infrastructure. The resources it has seized so far aren't enough. It must create new revenue sources. It turns to the most visible, most registered, most accessible assets: real estate, pensions, insurance products, business interests. These are all documented in government registries. The government knows who owns them. The government can seize them through legal procedures. It uses emergency powers to change the rules retroactively. What was protected yesterday is taxed or seized today. What was promised is restructured. What was supposedly safe is converted. Emergency property taxes are the first tool. Greece in 2015 introduced a new property levy on all owners of real estate. This wasn't an increase to existing property taxes. This was a new tax that didn't exist 6 months earlier. The assessment was based on government valuation, not market value. If the government valued your property at 500,000 euros, but you knew it was worth 300,000, you paid taxes on the government's number. Delinquent payments led to asset seizure. The tax was applied retroactively. You owed taxes for previous years immediately. The government framed it as temporary crisis measure. It remained in place permanently. Pension system seizures are the second tool. Argentina in 2008 nationalized approximately $30 billion in private pension funds. These were funds that individual workers had contributed to over decades. The government folded them into the public pension system. It promised that benefits would be maintained. Benefits weren't maintained in real terms. Inflation eroded pension values year after year. Retirees discovered that funds they believed were private and protected were neither. The government had seized them through legislative action and spent them on general operations. Forced conversions of insurance and bonds represent the third tool. In Weimar Germany, life insurance policies paid out their face value as promised. The problem was that the face value was in marks, a currency that had become worthless. A life insurance policy worth enough to buy a house in 1914 was paid out in 1923 in currency that could buy a newspaper. The insurance company honored the contract technically. The contract was mathematically destroyed. People received their promised payment in currency that was worthless. They had paid premiums for decades to receive nothing of value. Negative interest rates and wealth taxes represent the fourth tool. Governments force savers to lend at negative rates. If you hold 100,000 euros and the interest rate is negative 2%, you lose 2,000 euros annually just for holding the money. The government is taxing your savings through the interest rate mechanism. Japan has used this for 30 years. Savers have received near zero or negative returns while inflation has eroded purchasing power. France proposed wealth taxes on unrealized gains. Spain imposed taxes on bank deposits. All are framed as temporary measures. All become permanent. Real estate levies represent the fifth tool. Greece increased property taxes dramatically during the crisis. Lebanon seized property to cover shortfalls. Both framed these as emergency measures. Both made them permanent. The trap is that properties can't be sold because the market is frozen, but taxes are still due. Owners become trapped, paying taxes on assets they can't liquidate, in a currency that's becoming worthless to a government that's becoming insolvent. Debt restructuring through financial repression is the final tool. The government forces banks to hold government bonds. Banks offer negative returns. Savers are forced to lend to an insolvent government at losses. This continues until debt is resolved, which typically means decades of wealth transfer from savers to government. In Germany in 1923, the government seized gold holdings through executive order. It imposed emergency property levies. It nationalized businesses. Assets that were supposedly protected by property law were confiscated because the government was insolvent and the assets were visible. They were never restored after stabilization. In Argentina between 2001 and 2003, the pension system was partially seized. Property taxes increased dramatically. Vacation homes were subject to new levies. Tax liens were placed on properties. Many owners never recovered title because taxes accumulated faster than they could pay. In Greece from 2010 to present, emergency levies were imposed on property owners. The pension system was reformed, cutting benefits 40 to 60%. Insurance products were devalued. Emergency taxes targeted various assets. The middle class was destroyed while the wealthy, with international diversification, escaped. In Lebanon from 2019 to present, the government seized deposits through forced conversion. Then it taxed remaining assets to cover losses. It imposed capital controls to prevent escape. It effectively double-seized wealth. The middle class gets destroyed because they hold visible, registered, easy-to-seize assets. They can't flee jurisdiction like the wealthy. They can't hide assets like the poor in informal economies. They're most exposed to government authority. The pattern across all three stages is mechanical. Stage 1. Inflation silently erodes currency-denominated wealth. Stage 2. Institutions freeze, preventing access or conversion. Stage 3. Government directly seizes remaining accessible assets. The devastating part isn't that this happens. It's that people watch it happening and don't recognize the pattern until it's too late. But understanding this pattern changes everything. In every collapse, the same people lose everything. And it's not the poorest. It's not the richest. It's the middle class who followed the rules, bought what they were told to buy, and trusted the system they were embedded in. The wealth differential after collapse reveals a stark pattern. It's not random. It's structural. The wealthy survived because they diversified internationally. They had moved money to other countries before the crisis. When the home currency collapsed, they had assets in stable jurisdictions. They held hard assets, real estate in multiple countries, commodities, precious metals. They could pay bribes and navigate systems through professional networks. They had advisors who recognized patterns early and took action. They converted to hard currencies when domestic currency began weakening. They established foreign accounts before capital controls were imposed. By the time the government froze domestic assets, the wealthy had already positioned elsewhere. The poor survived because they were already operating in informal economies. They didn't depend on banks. They didn't have pensions. They used barter networks and cash transactions. They owned little that the government could seize. They didn't depend on formal institutions for survival. They had community networks that functioned outside the formal economy. When the formal system collapsed, they adapted because they'd never relied on it. The middle class was destroyed because they concentrated wealth in the formal system. Their money was in banks, pensions, bonds, insurance products. They believed institutions were safe because they were regulated. They couldn't diversify internationally because it required capital, knowledge, and connections most middle-class people didn't have. They depended entirely on currency stability for their purchasing power. They had too much to seize. When the government needed money, the middle class held the visible, registered, accessible assets. They followed official advice: stay calm, don't panic, the situation will resolve. By the time they understood it wouldn't resolve, Their options had disappeared. The Argentine collapse in 2001 provides clear evidence. The wealthy, approximately 10% of the population, had moved money to Uruguay or Miami before the crisis. They owned international real estate. They held dollars in foreign banks, not Argentine banks. When the peso collapsed and the Carlito froze deposits, they were largely unaffected. They escaped relatively unscathed. The poorer, approximately 35%, were already in informal economies. Street vendors, farm workers, construction laborers. They traded goods for goods. They built barter networks during the crisis. Some thrived in the new economy because they understood informal exchange. The middle class, approximately 55%, was devastated. Their savings were frozen, then converted to pesos at artificial rates. Real estate couldn't be sold because nobody had money to buy. Pensions were cut 40% or more. Jobs disappeared as businesses collapsed. They spent decades recovering, if they recovered at all. The mechanism behind survival is architectural. Assets outside government administrative reach survived. Assets inside government reach were seized. Knowledge and skills proved more valuable than paper assets. Relationships became currency. Physical possession, not legal ownership, mattered. What didn't help was following conventional advice. Trusting institutions destroyed people. Being honest and law-abiding provided no protection. Having high income meant more assets to seize. Education and credentials were only useful if the economy valued them, which it didn't after collapse. What helped was diversification outside the formal system. Understanding the pattern early and acting on it. Maintaining relationships outside institutions. Having practical skills that had immediate market value. Holding hard assets. Positioning before the crisis, not during it. The cruel irony is that the middle class was most encouraged by society to follow the path that destroyed them. Buy a house as your greatest investment. Get life insurance for security. Save in a pension for retirement. Get a university degree for career advancement. Get a job with a stable company. These are exactly the assets and positions seized first when the system fails. The government takes the house through property tax seizures and liens. The insurance policies are paid out in worthless currency. The pensions are cut or seized. The degree becomes worthless because the industries that valued it disappear. The job disappears because the company collapses. Following the system's advice destroys you when the system fails. This is the pattern across every collapse. The structures that are safe in stability become death traps in instability. The assets you're encouraged to buy are the first to be seized. The institutions you're told to trust are the first to fail. This isn't because the system is evil. It's because the system is designed for stability. When stability ends, everything optimized for stability becomes a liability. So, what does this mean? Is the answer to buy gold and hide in the woods? No, but understanding what survives and what doesn't changes how you should think about your wealth today. The people who survived weren't smarter. They just understood this mechanism before it became personal. The three-stage pattern is predictable because it's mathematical, not ideological. It applies to democracies and autocracies equally. It applies to rich governments and poor governments. It applies to left-wing governments and right-wing governments. The specific trigger differs. The political rhetoric differs. But the mechanism is identical. An insolvent government consumes accessible resources. This is math. Insolvent entities behave predictably. They consume whatever is within reach. They don't do this because they're evil. They do it because they're mathematically insolvent and survival overrides principle. Stage 1 is devaluation. Currency loses purchasing power. Savers are punished. The process appears temporary, so the middle class doesn't act. The warning sign is simple. Official inflation is lower than actual inflation. When the government says inflation is 2% and your grocery bills are rising 8%, stage 1 is underway. When your salary increase doesn't match your cost increases, stage 1 is underway. When your bank savings earn 1% while purchasing power declines 8%, stage 1 is underway. Stage 2 is institutional failure. Banks and funds become insolvent. The government imposes access restrictions. It's called a temporary measure, but by the time it's announced, it's too late to move assets. The warning sign is the announcement of capital controls or negative interest rates. Capital controls mean the government is restricting access to money. Negative interest rates mean the government is taxing savings. When either is announced, stage 2 is beginning. The window to act closes when this is announced, not after. Stage 3 is direct seizure. The government directly takes accessible assets using a legal framework. Emergency taxes, levies, bail-ins. It appears fair because everyone is asked to sacrifice. But wealth is redistributed upward to the political class and connected interests. The warning sign is the introduction of emergency property taxes, pension reforms, or forced conversions. When the government introduces a tax that didn't exist 6 months ago, stage 3 is underway. When pensions are suddenly reformed and benefits are cut, stage 3 is underway. When deposits are forcibly converted at artificial rates, stage 3 is underway. The structural truth explains why this pattern is inevitable. Seizure is a function of two variables, visibility plus administrative reach. If the government can see an asset and can administratively reach it, the asset will be seized. If the government can see the asset but can't reach it, foreign jurisdiction, the asset survives. If the government can't see the asset but could theoretically reach it, physical gold in your home, the asset survives. If the government can neither see nor reach the asset, knowledge, skills, relationships, the asset survives. This is architecture. It's not chance. It's not luck. It's structural. The government can see your house because it's registered. The government can reach your house through tax liens and seizure. Your house gets seized. The government can see your bank account because banks are regulated. The government can reach your bank account through administrative procedures. Your bank account gets seized or converted. The government can see your pension because it's registered with a pension administrator. The government can reach your pension through legislative action. Your pension gets cut or seized. The government cannot see your knowledge. You can walk across a border with your education in your head. The government cannot reach it. Your knowledge survives. The government cannot see your relationships. You can maintain trust networks that function outside official channels. The government cannot reach them. Your relationships survive. The government cannot see physical gold hidden in your home. The government would have to search your specific location, which requires knowing it exists. If it doesn't know, it can't seize it. The government cannot reach Bitcoin memorized as a seed phrase. There's no institution to seize. There's no account to freeze. The asset survives. The early warning system works like this. Stage 1 warning, official inflation is lower than your actual cost increases. Stage 2 warning, capital controls are announced or negative rates are imposed. Stage 3 warning, emergency property taxes, pension reforms, or forced conversions are announced. When you see these warnings, the stage is beginning. Understanding this isn't about predicting when it happens. It's about understanding what's actually happening right now and positioning accordingly. The pattern has always been somewhere else, until it's here. Roberto in Buenos Aires thought the crisis would happen in some other country. It happened to him. The Greeks thought they were protected by European institutions. They weren't. The Lebanese thought their banking system was stable. It collapsed. The Venezuelans thought oil reserves guaranteed security. They didn't. The pattern repeats in cycles. It's always somewhere else until suddenly it's everywhere. The current indicators are present. Global debt is at historical highs. The United States federal debt exceeds $36 trillion. Interest payments on debt have surpassed $1 trillion annually, exceeding the defense budget for the first time. The Congressional Budget Office projects that debt to GDP ratios will exceed 150% within decades under current law. Japan operates at 260% debt to GDP, sustained only through financial repression. The European Union faces similar trajectories. Italy's debt exceeds 140% of GDP. France exceeds 110%. These aren't signs of stability. These are signs of a system requiring ever-increasing intervention. To maintain the appearance of normalcy, central banks are experimenting with negative interest rates. This taxes savers directly. Capital controls are being tested in various countries. Emergency powers are becoming normalized. Asset seizure frameworks are being built. The European Union has bail-in frameworks in place. Central bank digital currencies are being developed, which would allow governments to control spending and freeze assets instantly. These aren't hypothetical future tools. They're being built now, published in white papers, discussed at central bank conferences, legislated in regulatory frameworks. The architecture of the next seizure is being constructed while most people debate whether it could happen here. It's happening here. It's happening everywhere. The point isn't prediction. It's recognition. This isn't about if but when and where. The pattern repeats in cycles. Recognition comes too late for most people. But early recognition changes options. When you understand the mechanism, you can see it beginning. You can recognize the warning signs. You can position before it becomes obvious. What this means is that the middle-class wealth structure is optimized for stability. That structure fails predictably during instability. Understanding the mechanism reveals alternatives. This isn't about hoarding gold or doomsday prepping. It's not about paranoia or conspiracy. It's about understanding what actually survives when formal systems fail. The question to ask yourself is simple. What assets do I hold? Where are they held? Can they be frozen, seized, or converted? What would I have left if all formal system access ended? If your answer is that you'd have nothing, you're exposed. If your answer is that you'd have some assets, some skills, some relationships, some alternatives, you're positioned. The framework for thinking about your assets is architectural. Understand visibility. Can the government see it? Bank deposits are visible. Real estate is registered. Pensions are tracked. Knowledge in your mind is invisible. Relationships are invisible. Understand access. Can the government reach it? Bank deposits can be frozen administratively. Real estate can be seized through tax liens. Foreign assets are outside administrative reach. Skills cross borders. Understand resilience. Does it work if systems fail? Bank accounts work if the banking system functions. Pensions work if the government honors them. Skills work regardless. Community networks work regardless. Understand diversification. Are you too concentrated in one asset class, one currency, one country, one institution? This channel doesn't predict futures. It dissects pasts. The pattern is already in motion somewhere. The question is whether you'll understand it before it becomes personal. The people who survived past collapses didn't have special information about timing. They understood the mechanism. They recognized the warning signs. They positioned before it became obvious. That option is available to you. Stage 1 begins when inflation exceeds official statistics. Stage 2 begins when capital controls or negative rates are announced. Stage 3 begins when emergency asset taxes or pension reforms are introduced. Watch for these. Understand the mechanism. Position accordingly. The pattern is mechanical. The mechanism is mathematical. Understanding it changes everything.